When I was at GRI Europe in Paris about 2 months ago, and then Expo Real, somebody mentioned it, uh, there was a huge sort of freeze on the other asset classes, but not the rented residential. And that seems to be the topic that even in these more challenging times, PRS, BTR, student are more viable sectors. Not shiny, but more likely to be of interest of investors, tenants, banks, and therefore the topic of conferences. So Craig asked me to, when we met first time, I don't remember whether it was at Expo or GRI, to deliver a short presentation where these asset classes are outside of CE and in CE, and what learning exercise it comes from this comparison. Um, so about 15 slides in 15 minutes, so my tempo will be quite prompt. So who is talking to you and where I'm coming from? So I'm from BONARD, Vienna-based research advisory specialist, 15 years, 700 investment clients that we service around the world, from 4 offices in Europe, Asia, and Americas. And we have completed and advised more than 520 projects. So we have some experience from the field. We are at more than 200 markets, city markets, almost 13,000 assets that we monitor, and 2 million bets. In Poland particularly, we already work with some investors, developers, banks. We have been here 5 years, so we have some track record and some field experience that we marriage all together with the international one and try to support the education and transactions and investments in Poland for these rented residential asset classes. So what's going on in the world? People rent more and more because they like it and because they have to. So over here you can see buy to rent ratio across Europe. In Poland, less than 15% people rent, while EU average is 30%. So, and we see only one direction: more and more people rent. It's not the other way around, that more and more people would buy. And so far they have been doing it because they liked it. They like to rent scooters, cars, furniture, and rent apartment. And they want to be mobile, flexible, uncommitted. They get married 5 years later than parents. They get mortgage 5 years later than parents, statistically. So there is a new gap, new window of opportunity for rented residential sector to cater for them. In Poland, out of the 141,000 dwellings completed a year in 2021, only 1.4% were for rent. So that's the comparison: build to sell and build to rent. Very small. The ratio is totally different in other countries. If in Poland only 5% of those who are buying an apartment now would be renting the apartment, we would be talking about 10,000 new beds every year and 1 billion euro invested every year. And this is most likely what we are heading to. Not next year, but in next years. That this volume of investment, about 1 billion and 10,000 beds a year, we will see here probably as of 2025 onwards. What are we talking about? So what's built to rent or PRS? These are synonyms. It's a institutionally owned building, about 250, 300 apartments and more, usually outside of a city center, providing about 70-80% of the GBA for rooms and the rest for communications and services. Besides BTR or PRS, we have PBSA, so purpose-built student accommodation, that differs from PRS in 3 major points. First, locations. So PBSAs are near universities, not near downtown necessarily. Second, it's not only rooms and services, but also community. So there are much richer communal areas. So rooms are probably 70%, communal areas and communications 30%. and size of the apartment. So student is usually 16 to 18 square meters net carpet area, while BTR and PRS are usually 20 square meters and more. But this presentation will be or is already available on our website, BONARD.com, so you can download it. Our team prepared also some useful comparisons, so you can see all rented residential asset classes here on the screen and how they compare to each other. We have student, co-living, micro-living, private rental sector, or PRS, BTR, single family, multifamily, senior housing. So these are all rented resi. Today we only talk about PRS and student. So what PRS is and what it is not. So PRS, modern studios and apartments built specifically for renting, one owner, one operator, and 300 tenants and more. Long-term renting establishments, so they don't come for a few days or weeks like in service apartments or hotel. They come for usually 3 months and more. It's a professionally managed building by professional operators. So we have the resident groups and the Marriotts and Hiltons of the PRS already. There are about 130 in the world. Not that many in Poland, but they are arriving. There are well-maintained public spaces. So the tenant comes all in one bill, doesn't need to care about internet or laundry, etc. Everything is in-house. And can have a shorter length of stay than in an individual apartment rented on a flat sharing market. What PR is not, it's not an affordable housing. One gentleman said about 2 months ago, we are not building affordable product, period. Okay, let's get used to it. This is for the upper 15% of the population who is extremely mobile for money or for fun or for necessity and want to have a good location, good services, flexibility, community. It's for the upper part of a society, not affordable. It's not social housing. It's not only for young people, and it's sort of massive lower quality apartments. That's not true. It's an upper scale quality of apartments. Examples. So this is a project in London, Wembley. So about 15 kilometers from Marylebone and Mayfair, but 8 minutes by train or 20 minutes by subway. So this is a typical build to rent or PRS location. Cheap land with good access. The land in this asset class is usually less than 25% of the total turnkey ticket. So you can imagine that this asset class is not aiming for CBD. This is 5,200 apartments, so it's a mini city. Very good example. When you come home and click on it, you will learn a bit more about how the proper product looks like. But they have studios from 40 to 120 square meters, different sizes, different rents, different lengths, different amenities, so you can check. From Poland, I'm sure you know Resi for Rent from our colleague Griffin. It's a very good and successful product in a way that it opts for good locations, good sizes of apartments. Most of the newcomers make mistake that they make the apartments too big. It's a waste. The smaller, the better. The tenant doesn't spend so much time in the apartment. He or she is coming temporary and is here to spend time in work, in society or communal areas, but not necessarily the room. So the room sizes are small. From the market research we have done and regularly do here in Poland for occupancies, this has been very well mobilized in terms of occupancies. It was occupied very quickly. Normally, build to rent products, mobilization of occupancies takes 2 years. So when we underwrite projects in UK or Germany, the 98, 99% occupancies are projected for year 2, not year 1. Here in Poland, to my knowledge, except of 2 properties, in PBSA and PRS, all of them have been 99% occupied within first 6 months, and 90% of them in first 2 weeks, which says a lot, A, that the market is heavily undersupplied. There could be easily 20 new projects in Warsaw tomorrow, and they would be all full. But also that they are underpriced. So the rents could be much higher than they are, and they would still be occupied. What is PBSA? It's a purpose-built student accommodation. It's much more advanced sector than PRS. It's probably 10 times more than PRS. So it's established asset class, which is yield, transactions, transparency. As I said, about 70% are rooms, 18% communications, and 12% communal areas. There are usually 10 and more amenities for students and young professionals, so library, laundry, restaurant, communal kitchen, lounge, gym, bar, study room, car parking, bike parking, etc. The asset class is as advanced that it is segmented to 3-star, 4-star, 5-star now. In Poland, we usually see 3 and 4-star. We don't have a 5-star product here yet. And brand. Example, this is from Lithuania, from Kaunas, so B city by population, by A city by student population. This is an asset of 225 rooms, started at 170, did 2 build-ups because they were full and they have a very, very long waiting list. Probably they could sell that property twice. And this will give you an example of a good asset that might serve as a reference point. Some of the brands and investors and stakeholders already present at the Polish and CE market. I have to say one important thing. Poland is only one of the 6 sizable markets in Europe after UK, Germany, France, Italy, and Spain. So most of the investors that we work with, institutional insurance, private equity, they look for scale. And Poland is only one of the 6 countries where they can deploy 100 million and more. So that's why Poland recently is so sought after for PRS and PBSA. So that we already see some institutional investors. When we do the surveys on investors, 85% of them would like to be in Poland, but about 10 to 15% would invest now. So it's clearly the education stage, and we expect that this will sort of arrive in next 2-3 years in a bigger scale. But when we have conversations with, I cannot name, but let's say the biggest institutions, they would already stepped in, but there is no portfolio 100 million plus to buy. So this is the stage when we had in France, Germany, Spain 10 years ago, when we are helping to build portfolios so that they can be transacted later on. So this needs to be developed from high net worth individuals' money or families' money or private equity, building by building, and then transacted as a portfolio at a portfolio yield premium, which is about 50 to 75 bips in these asset classes. Yields. So this is a benchmark comparison of yields across the cities in Europe, including Warsaw, so that you can see how do they reference to each other. In general, to provide a short analysis, the let's say PBSA yields are usually about 100 bips greater than the prime office, and build to rent is usually very close to prime office at mature markets. Okay, in Warsaw the situation is different. So the PBSA yields are more than 150 bips greater than prime office, but PRS is also high because it's immature, very immature asset class here. You can see it here, the delta in between student, multifamily, or BTR. And so the delta, when you look at Madrid, can I point here? Is it a pointer? Correct? Okay. Good. So, when you look at Madrid, third from the right, so the delta in between student and PRS is really great because there are different maturity. But in Warsaw, it's very small, which is usually as small as London, where both of the asset classes are quite mature. But if I go one back, the yield game in these sectors is beneficial to some. First, the yield still compress, so they have somewhere to compress. It's an immature asset class. Second, when we compare the yield compression potential in between rented resi and prime office, it's still 100, 150 bips. So unlike the office or let's say hotel or retail, in rented residential, the investor can play the yield game. So I explain how it works in PRS. Normally at the private equity level, the investors play IRR game. So this is not the long patient money for single digit returns, where institutions park money in rented resi, but these are the players who want to make money with sort of 15% IRR plus and 7% initial development yield. I will get that. So acquisition in year zero, 2 years of construction, no more. Most of the PRS, even in his Poland, was built below 15 months. It's a vanilla product. It's very fast. And I'm talking about conventional construction. If I factor in modular, it's even faster. So in Brno, we did with Raymond, CTP, the entire building from blueprint to first tenant, 7 months. And you can imagine how it sweetens the IRRs, right? So it goes really fast. Here, it's been 13 months, 15 months, so it's very fast. And therefore, the development should not take any more than 2 years with all the permits. I know you probably will quote me on this, but permitting here in Poland is very easy. I know you don't feel that, but Prague, Munich, Madrid, you can get a permit below a year. In Prague, 5 to 10 years. So that's a totally different story. So the development is very convenient for the speed and IRR. Then, when the building is completed, the occupancy starts. Mobilization of occupancy starts 12 months before opening. B2B, selling the rooms to institutions, employers, students, etc. And then 6 months before opening, there is promotion to B2C market, so direct end tenant. First year, you set up basic rent, you reach 99% occupancies, waiting list, which allows you second year to increase the rents, not only the occupancies, consolidated exit. The yields compress in between the entry and exit around 75 bips. So you not only play the game of consolidating occupancies and rents, but also the yields compress meanwhile. Moreover, you consolidate the NOI, which at the beginning is about 65%, the triple NOI margin. But PBSA usually exits about 70% plus NOI, and BTR about 85% NOI margin. So can you hold that question? I'm very close to finish, and then I think we can discuss. This is the maturity level. So sector cycle. Poland is no different from what happened in France or Germany 10 years ago. Same Tesco's and Kauflands come here, so same PRS and PBSA will come here. It just happens 10 years later. So we can anticipate what will happen. So we see the stages of sector maturity from initial development to growth, consolidation, maturity, and decline. Below the graph, you can see the type of customer that is or tenant that is adopting this product. And below, you can see the competitive level, net initial yield, and IRRs. Of course, this is illustrative. It's market by market, deal by deal, city by city. Size of the property also matters. You transact 700 beds differently than 150 beds. So we cannot generalize, but this is roughly to provide you a reference point about the asset classes elsewhere in other markets. So the pin is at the stage where we believe Poland is. So at the beginning of a growth stage, where the first product was delivered, transacted, um, uh, banks get used to the product, cities get used to the permits, etc. And now it can reach the scale. So we believe that there are fundamentals for that. Not to mention that rented residential is very positive in the eyes of the investors because the rents grow faster than inflation. Not like in office, not like in retail. Here, year on year, increase of rents in PBSA in average 17%. In Krakow, 25. Private rental market, so flat sharing, in between 15 to 29% increase. More in Krakow than in Gdańsk, more in Wrocław than in Warsaw, but in average 15 to 29. It's more than inflation. So moreover, you can adjust your rent every year or every month because your tenants are coming and going. It's not like you sign office for 5 years indexed to inflation. Here you can increase every year. So you are de-risked and sort of on a safe side of the river. So sort of a benchmark on what is the asset class in general. Land cost usually represents no more than 25%. When we underwrite projects in CBD or northern part of Mokotów here, it's usually 900 to 1,100 euro per square meter of PUM. And we still can underwrite such project here. The rents will sustain such an expensive land, just to give you a reference. Turnkey costs, the institutional investors will not buy any property of PRS or PBSA that is not ESG friendly. That's one thing. Second, that is not north of 30 million, and which is not north of 200 beds. That's the institutional product. That if you are thinking about it now, you should already follow these exit scenario preferences of institutional investors. So most of the projects in Poland and CE, we work about 30, 40 million turnkey ticket. Initial development yield, before everybody increased, the expectations were 15% IRR and north of 6% initial development yield. Now it has increased to 18% and 7% plus, because whether we like it or not, we are entering opportunistic times. So the deals need to be labeled opportunistic to go through. GRI, so gross rental income, is basically expected on a 99% occupancy, 12 months. Nothing less. Really, the assets in Poland were 99% occupied, except those two I mentioned, the last 3 years across COVID. So if COVID tested the market the way that occupancies are so high, we should not be that concerned about the way forward. OPEX, so the direct costs, utilities, HR, marketing, security, insurance, property tax, etc., create about 20 to 23% of the total GRI. You need to top it up with a sinking fund, which is the reserve fund for repairs, which happen every 7 years. So altogether, when you get off the tax, property tax, OPEX, and sinking fund, you arrive to a triple NOI, which has impact on valuation, which is, as I said, in students 65 to 70, in BTR 80-85%. Exit yield. I think I commented on this, but student, for example, is now traded for 100 bips less than 5 years ago. So the compression is about this level. PRS, we can say, because there has not been many transactions, so that we can have a sufficient representative sample to say where are the yields. IRR, as I mentioned, the expectations are now 18% plus. So this has become a norm across Europe, not only Poland. So the deals need to be opportunistic. Not many deals. If you have such, please tell me. But we work about on 30 transactions now in Poland, and many of them are not there because of the sort of asking price. Okay, and when we look at the deal, so rents go up, cost of money is up, cost of construction is going down now. Developers are sort of reasonable on their margins and much more reasonable than before war. So the only ones who are missing the train are the sellers who have not relaxed their expectations. And if they only agree to September 21 prices, I think many more deals would go through over here in Poland and would be north of 18% IRR. LTV, so the LTV that we have had the chance to be part of underwriting here in CE were usually around 55 to 60%. So the banks, I think, understand now the asset class. They are still conservative because they underwrite higher LTV in other asset classes, but still, they are cautious, so they are usually at this level. So I hope this has provided you some kind of a reference. I'm here with my team over here, Vasil, Alex, and Goras. Can you identify yourself? Thank you. And if you have any more questions individually, and this 20 minutes was not enough, happy to have a conversation. And the presentation is already available on the website for your download. Thank you very much.
Okay, Samuel, thank you very much. Just one quick question before we start is, 5 years ago, we put PRS as one of the categories in the awards, and clearly no one cared. All of a sudden, now everyone's caring more and more. What do you think changed the dynamics in Poland to actually make PRS such a interesting sector?
I think rents reached a sufficient level. So that helps to sort of reach the sufficient returns, Then it needed time to educate developers, GCs, city halls. So there is always about 3 years education period. Banks, without banking and financing, the asset class does not exist. And I think it needed Heimstatten to come.
Yeah, great. Yeah, that helped, of course. That kicked it off. Okay, well, thank you very much. Great presentation.